The UK economy has shrunk again, deepening concerns across the nation and raising urgent questions about what lies ahead. This latest downturn is not just a blip on the radar. It's a sign that the challenges facing Britain are growing more complex and difficult to overcome. The news is sending shockwaves through businesses and households already struggling with high living costs, rising energy bills, and the lingering effects of global instability. For many, the pressure is mounting, and the sense of uncertainty is palpable on every high street and in every home. The latest contraction of 0.1% in May 2024, following a steeper fall in April, signals more than just a bad month. It's a warning of deeper trouble. Economic indicators are flashing red, and experts warn that the UK could be on the brink of a prolonged downturn if urgent action isn't taken. The specter of recession now looms large, with families feeling the pinch from persistent inflation and stagnant growth. Everyday essentials are becoming harder to afford, and the anxiety about the future is growing, especially among the most vulnerable. For the new Labour government, this is an early and formidable test: how to revive growth without reigniting inflation. The eyes of the nation are on policymakers as they grapple with tough choices, balancing the need for stimulus with the risk of making inflation worse. Job security, mortgage payments, and daily costs are now top concerns for ordinary people. Many are worried about keeping their jobs, paying their rent or mortgages, and making ends meet as prices continue to rise and wages struggle to keep up. The path forward is uncertain, demanding careful navigation from policymakers and caution from consumers and investors. Economists are divided on the best course of action, and the financial markets are reacting with volatility, reflecting the deep unease that pervades the country. In this video, we'll break down the numbers, explore the causes, and help you understand the forces shaping the UK's economic outlook. We'll look at the data behind the headlines and explain what it really means for your wallet and your future. We'll also explain what a recession could mean for you, how it might affect your job, your savings, and your everyday life. Whether you're a business owner, a worker, or a retiree, these changes could have a direct impact on your financial security. We'll also look at how markets are reacting, from the London Stock Exchange to the local shops, and what these shifts signal for the months ahead. The response of investors and businesses will play a crucial role in shaping the recovery. And most importantly, we'll share practical steps you can take to protect your finances, manage your budget, and prepare for whatever comes next. From saving strategies to tips on reducing expenses, we'll help you navigate these challenging times. Understanding the current economic climate is the first step to making informed decisions in these turbulent times. Stay with us as we guide you through the storm, offering insights and advice to help you weather the challenges ahead. Let's break down the numbers. The ONS reports UK GDP fell by 0.1% in May 2024, after a 0.3% drop in April, 2 straight months of negative growth. The 3-month average shows zero growth, confirming economic stagnation. This means businesses aren't expanding, investment is on hold, and job creation is slowing. The services sector, the UK's largest, recorded zero growth. Production fell 0.2%, and manufacturing shrank by 1%. Construction also declined by 0.3%, hit by poor weather and economic uncertainty. This isn't just one sector struggling, it's a broad-based slowdown. When all three pillars, services, production, and construction, are weak, the economy is in a precarious position. The data paints a clear picture. The UK is treading water with little sign of forward momentum. Several factors pushed the UK economy into reverse in May. Exceptionally wet weather disrupted construction and retail, keeping shoppers at home and stalling building projects. High inflation remains a major drag, with rising costs for essentials outpacing wage growth and squeezing household budgets. April's increases in national insurance, council tax, and utility bills left families with even less to spend. This cost of living crisis directly translates into weaker economic activity. Internationally, new U.S. tariffs in April hit UK exports, exposing vulnerabilities in trade relationships. Combined with global uncertainty and domestic headwinds, these factors created a perfect storm that tipped the UK into contraction. The result, a broad-based slowdown with few easy fixes. The word recession is everywhere these days, splashed across headlines and debated in boardrooms. But what does it actually mean for a country, for businesses, and for ordinary people? In economic terms, a technical recession is defined as 2 consecutive quarters of negative GDP growth. This means the economy is shrinking, not just for a month or two, but over a sustained period, signaling a real and persistent downturn in economic activity. While the latest figures for April and May are certainly worrying, it's important to note that a recession isn't officially declared until we see more consistent negative data. Economists and policymakers are watching closely, waiting for confirmation before sounding the alarm. Earlier this year, the UK narrowly avoided slipping into recession, but the threat of a so-called double-dip recession, where the economy recovers briefly only to fall back again, is now looming larger than ever. Looking back, recent history is crucial for context. The UK experienced a shallow recession at the end of 2023, following the much deeper and more severe downturn during the 2020 pandemic. These events have shaped the economic landscape we see today. The impact of these past shocks is still being felt. Higher levels of government and household debt, increased inequality, and a fragile pattern of growth have left lasting scars on communities and businesses across the country. As a result, economic forecasts have been repeatedly downgraded. Even the most pessimistic predictions from just a few months ago now seem almost optimistic compared to the current outlook. The trajectory we're on is one of stagnation and uncertainty. For business owners, workers, and families, this makes planning for the future incredibly challenging, as the risk of further shocks remains ever present. With the risk of another downturn growing, both policymakers and the public are on high alert, bracing for what could come next in this unpredictable economic climate.
Economists are watching the data with growing unease.
The consensus is clear. The risk of recession has jumped.
Back-to-back contractions and weak fundamentals are flashing warning signs.
Consumer confidence is low, business investment is hesitant, and government options are limited by high debt.
The UK economy is vulnerable to shocks, with little bounce left after Brexit, the pandemic, and the energy crisis.
Some experts say we're already in a soft recession, even if it's not official.
The debate now is about how long this weakness will last, especially with consumer spending under pressure.
A few optimists point to falling inflation and a still resilient labor market, but most remain cautious.
The overwhelming sentiment, the path ahead is risky and uncertain.
Financial markets reacted swiftly to the weak GDP figures.
The pound fell against major currencies, reflecting shaken investor confidence.
A weaker pound makes imports more expensive, adding to inflation worries. The FTSE 100 saw volatility, especially among UK-focused companies in retail, hospitality, and construction.
Investors are in risk-off mode, wary of future growth.
Markets now expect the Bank of England to cut interest rates sooner and more aggressively.
Lower rates could further weaken the pound, but are seen as necessary to support the economy. The bank faces a tough balancing act: support growth without reigniting inflation.
All eyes are on the Bank of England and its next move. The financial world is watching closely, as every decision made here has ripple effects across the UK economy and beyond. Investors, homeowners, and businesses alike are waiting to see what comes next, knowing that even a small change in interest rates can have a big impact on their daily lives.
The base rate stands at 4.25%, after 2 years of steady hikes aimed at bringing down stubborn inflation. These increases have made borrowing more expensive, affecting everything from mortgages to business loans. The bank's strategy has been to cool off rising prices, but it's come at a cost for many households and companies.
But higher rates have slowed the economy, with consumer spending and business investment both taking a hit. Now the debate has shifted to when the bank will start cutting rates, as concerns grow about a possible recession and the health of the job market.
The case for a dovish pivot is growing stronger. Pressure is mounting from financial markets, business leaders, and politicians who argue that lower rates are needed to support growth and prevent further economic pain. Many are calling for the bank to act sooner rather than later. The bank faces a tough dilemma: cut rates too soon and risk reigniting inflation, or wait too long and risk a deeper downturn. Every decision is a balancing act, with real consequences for millions of people. Market expectations now point to a rate cut by late summer or early autumn, with another likely by the end of the year. Investors are already adjusting their strategies, and businesses are planning for what comes next.
Any move will be cautious, with the bank repeatedly stressing its commitment to controlling inflation above all else. Policymakers know that credibility is on the line, and they are determined not to let prices spiral out of control again. The future path of rates depends entirely on the data in the coming months. Every new inflation report, jobs number, and growth figure will be scrutinized for clues about what the bank will do next. The bank must balance the risk of recession against the threat of persistent inflation, knowing that its decisions will shape the economic landscape for years to come. For investors, a slowdown means shifting to a more defensive strategy.
Focus on sectors that hold up in tough times: utilities, healthcare, and consumer staples. These industries provide essentials people keep buying, even in a downturn.
Be cautious with cyclical sectors like discretionary retail and real estate, which are hit hardest when spending slows.
Infrastructure is a potential bright spot, as government stimulus may target long-term projects.
Look for quality companies with strong balance sheets that can weather the storm.
Downturns can reveal long-term opportunities for patient investors. The key: prioritize stability and resilience over risky bets. A careful, diversified approach can help protect your portfolio until recovery arrives.
The UK economy stands at a crossroads with stagnation and recession risks rising. The slowdown is broad-based, driven by inflation, poor weather, and global uncertainty. Policymakers face tough choices and markets are nervous. For individuals, this is a time for caution. Review budgets, build savings, and avoid new debt. Investors should favor defensive sectors and be wary of those exposed to consumer cutbacks. While the outlook is challenging, economic cycles do turn. Downturns are followed by recoveries, and opportunities will emerge for those who plan ahead. The key: stay informed, make prudent decisions, and be ready for the eventual upturn.